This is Jim Bell. Thank you for joining us today. I'm the founder and chief investment officer at Bell Investment Advisors. Our webinar today is going to cover the theme of flexibility in the U.S. market, and this is flexibility in policy or policies and how it's affected the market in the U.S. and on a global basis. So thank you again for your attention. You do have a chat box on your system there. I encourage you to use that to submit questions. We will attempt to answer your questions live as we go through the presentation. If we aren't able to answer them live, I will definitely get back to you to discuss the question that you have. If you're having any technical difficulties, you see our 800 number there at the bottom right, 800-700-0089. Give us a call, and I think someone here can help you. So very good. Let's get right to it. When I was thinking about putting this presentation together over a month ago, what I wanted to focus on were what I call these three flex points, or the dynamic of flexibility in regard to interest rates, inflation, and the U.S.-China trade dispute. A few weeks ago, these were the primary focus of what the stock and bond markets were concerned about. Since then, the issue of the global economic slowdown has really come to the fore. So I thought it was important to add a second section on the global economic slowdown and how this affects the three major economic regions in the world: China, Europe, and the United States. So let's go ahead and get right to it. So we're going to start by dealing with the U.S. Federal Reserve and the issue of interest rates. This first point is important. The Fed has definitely moved to the sidelines with what were considered threats of their process of raising interest rates, perhaps too aggressively, which the market was very concerned about. But in a very short period of time, since just December, the Fed has really turned around their point of view. They were estimating 2 rate hikes in 2019. That's now completely off the table, according to what they say. So there'll be no more rate hikes this year, and that's a very dramatic and quick change from December. This pause in Fed activity, mainly raising rates, is very accommodative to economic growth, as opposed to the threat to economic growth that raising interest rates causes. There are even suggestions that the Fed may consider a rate cut this year in 2019. So this is a dramatic change and an important turnaround in consideration to the interest rate market and how it affects bonds and other debt and the stock market as well. To kind of broaden out our perspective, the Europeans have already reversed course in a more dramatic way than even the U.S. Fed is talking about. They've turned away from increasing rates to stimulating the economy with lower rates and cheap money, which in classic terms is certainly a stimulation to economic growth. But the response of the U.S. Fed to the Great Recession in that period of 2007, 2008, 2009 was to drop interest rates to between 0 and 0.25%. So very, very dramatic crisis-like move on the part of the Fed. A second part of their response to the Great Recession was to also go into the open marketplace and purchase bonds to basically take them out of the marketplace, which would help keep interest rates low and stimulate the economy. This activity, the drop in interest rates and the Federal Reserve building up their balance sheet in terms of purchasing bonds in the open marketplace, this is known as quantitative easing, or QE. Coming out of the Great Recession, as the U.S. economy certainly grew, and we saw growth and stabilization across the world, the Fed wanted to begin raising interest rates to return them to what would be a more normal level and relationship to the rest of the credit markets here in the United States and overseas. Another part of that, as I mentioned about the balance sheet that they built up in buying bonds, they also began to sell off the bonds in their balance sheet, again to bring it back to historically what would be a more normal level. So these two actions, raising interest rates and selling off assets, it's just the opposite of quantitative easing. In fact, it's quantitative tightening, hoping that the strength of the U.S. economy and U.S. businesses would be able to handle this attempt at normalization. With this slide, I wanted to take a look back at the historical, some history in terms of Fed target interest rates. This chart goes all the way back to 1983, so it's a very good bit of history. One of the things that's observable here is that the Fed target rates, as they move through time here, they kept reaching lower highs and lower lows. That's an important dynamic in kind of financial analysis. When your highs are lower than the previous high and the lows are lower than the previous lows, and you can see where it brought us to this historic point where, again, as I mentioned, in response to the Great Recession and the financial crisis, they literally dropped rates to almost zero, or between 0 and 0.25. And they left it that way for quite a period of time between 2008, 2009, and they just began to increase those rates very gradually in 2015. So interesting perspective on history. You can see that where the Fed funds rate sits at this point, that it's between 2.25 and 2.5%. It is above where the rates fell to in response to the tech bubble bursting in 2000, 2001, and 2003. So that's just a bit of historical background that points out how kind of remarkable and not normal is the period that we're in right now. So I'm going to switch focus now away from interest rates a bit to the issue of inflation. Just as a bit of background, the U.S. Federal Reserve has a dual mandate from the U.S. Congress to control prices in our marketplace, which is what inflation is all about. It's about controlling prices, keeping prices stable, which is helpful to business planning, growth, and transactions. And its second mandate is to provide as much as possible full employment. So we're certainly at that point where we have the lowest unemployment rate in 50 years, and inflation has been pretty tame. In fact, it's been a bit of a disappointment. In terms of economic health, you want a certain amount of inflation because it's a sign that the demand is higher than the supply for goods and services. And on the demand side, the producers need to pedal fast to catch up where the demand is, and that's a healthy economic environment. So the Fed has set what they can think of as a neutral target of 2%, and a current debate that shows another part of flexibility within the Federal Reserve is that they're debating whether they've been too hawkish or too conservative or concerned about inflation running away. And there's the debate going on that perhaps they should let inflation run beyond 2%, not be afraid of it getting out of hand, since it's with the U.S. economy, it's been very difficult for the inflation rate to reach 2% and stay there. So they think they're being too fearful and cautious about inflation at 2% or above. So next, I want to turn to China in terms of the issue of flexibility. As you know, we've thanks to President Trump, we've been in a trade war with China for over a year now. The kind of one of the latest dynamics is the president originally set a March 1st deadline to come to a trade agreement with China, or he was going to dramatically raise tariffs on more Chinese goods. In the words of the president, because good progress was being made in these negotiations, he waived that March 1st deadline. So there's been no more activity in terms of raising tariffs or starting new tariffs, which is definitely a positive. The president is in the process, and his negotiating team, of setting up a summit with President Xi of China, where the president would like to have a dramatic signing ceremony that spells out important agreements that have been reached in this dispute with China. But China did observe the Hanoi summit with Chairman Kim, where North Korea and the U.S. met in Hanoi, and nothing came of that summit. It was a big disappointment, and our president, cut it short and came back home before the scheduled time had been allotted for that so-called negotiation. So the Chinese are worried that, well, they're concerned about President Trump's skills at negotiation. Can he really accomplish serious progress in negotiation? It's far more show than substance in terms of North Korea, and so this has given them pause in terms of the importance of China. Our Fed Chairman Powell has asserted that the biggest economic threat to U.S. growth is the slow growth in China and in Europe. So it gets back to this global slowdown. As part of that, marking that concern, Chinese exports plunged by 20% in the month of February. It's kind of ironic to us that just back in 2017, we were celebrating synchronized growth around the world with all economies growing at the same time. Now we're in an opposite position where we're experiencing a synchronized slowdown of the global economy. One point I'd like to make, and I'll probably come back to it, is that slow growth is still growth. And in our view, the chances of a recession are still very, very limited. More about China. Their National People's Congress is going to meet soon to rewrite the laws of foreign investment. The big questions in our negotiations with China is, will this kind of move, or the negotiations, will it kind of address or solve the problem of how Chinese policy has been to block access to the United States and other foreign interests in the Chinese economy, block access to some of their markets? Will the National People's Congress rewrite to stop the theft of intellectual property, which is quite dominant in doing business with China? And will the rewrite stop the policy of forced transfer of technology when foreign companies do business with other Chinese companies? So we're gonna switch now to the second part of the presentation, which is dealing with the global showdown. As I mentioned before, in China observing the Hanoi summit, it gives them some pause in terms of working with Trump. Trump kind of stepped on his own foot again, I believe, last week when he said that the tariffs he already has imposed on 250 billion of Chinese imports will stay in place for a substantial period, even after the U.S. and China reach a new trade agreement. That's definitely a poke in the eye at the Chinese negotiators, and not helpful in terms of moving this trade dispute forward. In response, China is hardening its position because it sees its leverage improving against Trump. And just another economic issue, China is fighting a national labor shortage, which is certainly an impediment to economic growth. So let's turn to Europe, the other major economic zone in our world economy. Unfortunately, European banks have fallen back into the position where they need to be subsidized by their governments. In Germany, bond yields have turned negative again for the first time since 2016. There was progress being made there, which has now gone backwards. A recent report in March showed that the Eurozone factory output declined at the most rapid pace in 6 years. And the issue of Brexit is very serious. The United Kingdom is paralyzed in regards to how to execute Brexit, which the UK population voted for. It's just not ready politically or economically. The public may have voted for Brexit, but they didn't instruct the government on how to do it. And the government doesn't know how to do it. It seems like nobody in Britain does know how to do it. So my hope is that they'll bring it back to a vote now that they've had 2 or 3 years to learn about the hazards and cost of what Brexit is going to be. In terms of the United States, we see the U.S. economy and circumstance as a mixed bag. On the positive side, we're appreciating a more flexible approach to monetary policy in regard to the Federal Reserve. The tensions between U.S.-China at least are somewhat better. There's not a bitter standoff or boxing match. There is some comedy, some agreement to want to make progress. U.S. corporate earnings continue to be strong and look strong. We have this healthy employment situation where wages are increasing at a 3.4% annual rate. and that may continue to increase. Our unemployment rate is historically low, at about a 50-year low at 3.8%. And as far as the consumer and household confidence is quite high in the economy. On the other side, and just in terms of the negatives, this trade war has been damaging. It's made goods more expensive for U.S. companies and U.S. consumers. This is something that President Trump doesn't seem to be able to appreciate, that it's we, the consumers, and we, the business owners, that are paying for the tariffs he's so proud of, as he likes to call himself, Tariff Man. But tariffs are destructive instruments. They do cripple the economy, whether it's in the United States or around the world. The U.S. economy is definitely slowed down. The Federal Reserve is now estimating that growth in 2019 will be 2.1%. That's below the 3% or so that we saw in 2018. The White House, not surprisingly, is more confident. They're estimating a 3.2% growth rate for 2019, which will actually be higher than it was in 2018. A disturbing fact is that the Great Recession was a real game changer, and even today, there are fewer U.S. residents invested in stocks than before the Great Recession. So the wealth creation that's gone on in the stock market since the Great Recession, fewer people are taking advantage of that or are enjoying that positive growth to their net worth. Also, U.S. manufacturing slipped to its lowest level in nearly 2 years. And finally, just to draw this to some conclusions, it's important to recognize that the Fed is our friend. Second point, as I mentioned, China wants to work out a deal before Xi and Trump meet to avoid a repeat of the embarrassing end to the Hanoi summit. Federal Reserve Chairman Powell asserts that the biggest threat to the U.S. economy is the slow growth in China and Europe. So the resolution of these trade disputes is even more important. Another concern is that there's fear that the U.S.-China negotiations have come to a standstill, that they've reached just points of trouble where finding agreement has been out of reach. And that's a concern. The longer this goes on, the more difficult it's going to be for the U.S. and the world economy to grow. Europe's in trouble. It's falling backwards. The United Kingdom does not know how to execute Brexit. So as I said, I think they should bring it up again for a vote after, I think it's been about 3 years that the UK citizens have seen what an issue it is. The sixth point here is that the U.S. is in a mixed bag. There's high household confidence and increasing wages, but the trade war is slowing the U.S. economy. So not to end on a completely negative note, I just want to add that the U.S. labor force participation is improving. People are coming back into the labor force because jobs are available. That's very positive. Previously owned home sales soared in February, so the housing market really showed a dramatic recovery. Mortgage rates are falling today, so that's going to help the housing market. Another point I'd like to make is that although U.S. government bonds are falling in terms of their yields, our government bonds actually do have a yield, and that's hard to find sovereign bonds in the world that actually have a positive yield. So our situation being positive does attract capital. So foreign investors they find buying our U.S. bonds attractive. since they can't find yield elsewhere. That'll help keep our interest rates yield as that demand for government bonds increases. Finally, economic and business fundamentals still point towards growth in the U.S. economy, and a recession seems to be a distant possibility. So that's the formal part of my remarks today. If you do still want to submit questions, I will take those and get back to you personally. I'm sure you have our contact information. We love to hear from you. We have recorded this webinar. It'll show up on the library on our website next week. And you can see the inventory in our library here. If there's anything that catches your eye there that you would like to listen to, we certainly welcome you to go back and hear what we have to say there. There's lots of ways to connect with us, from our website to our LinkedIn. Bonnie continues to write a career and life coaching blog. We also write a finance blog. You can see the addresses there. And you have our phone numbers, I'm sure. So as I said before, today's presentation slides have been recorded, but if you would like a personal copy of them, you can send that request to us. Thank you so much for joining us today. Our next webinar is going to be mid-May, and it'll be an update of our investment committee as we start the new quarter in April. Look forward to hearing from you. Thanks again. Bye-bye.